Well, good afternoon, everybody. It's Tuesday, and we are coming to you from the road in Oklahoma City, Oklahoma, specifically Norman, Oklahoma, where we are over at the Rani Irani Center for Energy Solutions. As the world gets back to normal and we start traveling more, we'll probably be doing more of these remote broadcasts. We're really lucky that the folks at the Rani Irani Center, David Ferris and his team, would let us come over and shoot today's episode. We've got a phenomenal discussion for you today. We'll be joined by Mike Bradley, Colin Fenton, and Matt Portillo as usual. But we've got a special guest. Michael Cohen is joining us. He's the chief U.S. economist and head of oil analysis in BP's group economics team. He's responsible for the oil transportation and U.S. energy policy related analysis in BP's statistical review of world energy and energy outlook. Prior to joining BP in May 2019, Michael was Barclays global head of commodities research and was responsible for preparing and delivering differentiated research on commodities markets to all of Barclays' clients. He worked at the U.S. Energy Information Administration, the Department of Energy's Office of Policy and International Affairs. He's just got an incredible amount of experience, and as you all know, BP has made some noise with some new thoughts about strategy and where they think the world is headed. So we're delighted to have you today, Michael.
Thank you, Maynard, for having me. It's really an honor to be here, and I've seen all the work that you all do, and I think it's some of the greatest in the business. So really pleased to talk to all of you.
Well, we're really lucky. That comment's worth its weight in gold. So thank you, Michael. Maybe before we jump in with the guys, I do want to thank the team here at the Rani Irani Center. Rani is a fantastic energy entrepreneur. He endowed the center here. The mantra is, taking the boardroom to the classroom and vice versa. So the mix of shareholder issues, governance issues, practical knowledge, and also professional development. David Ferris runs the center here. It's a really neat part of the University of Oklahoma. They're doing great things. I know they would love for you to visit them anytime you're in town, all of you out there. So big plug for what Ronnie and David and the team is doing here. And thank you for letting us use your space. It's great space. So let's kick it off. Mike Bradley, what's going on in the world? Had a little bit of news this week in energy markets. What would you tell us?
Oil and gas are up a little bit today. Looks sort of like a risk-on trade for early in the week, but we're really starting earnings period. I mean, oil service earnings are kicking off, and we've had in the last week or so some merger announcements in E&P. So right now there's a lot going on in energy, but we don't seem to be making a whole heck of a lot of headroom here. I mean, things are pretty much range bound, and it's just because there's just not a lot of conviction as we go through earnings season, and as we 2 weeks away from an election. So right now, the group is just kind of blah.
Well, that's what I keep hearing, Mike. Apparently, there's an election coming up, and people seem to think it matters. But Matt, what do you think? Head of research. I know we've been doing some new things in TPH research. Anything you'd share with the group?
It's been extremely busy over the last 2 weeks. We launched on Darling Ingredients and weighed in on the renewable diesel market. We also put out a very large renewable report kind of touching on global power and our views over the next decade. We will be hosting a call for that tomorrow, so I'll save a lot of the context for that call. But if you have interest, reach out to your TPH rep and they get you the dial and information. Really, from a client perspective, we've been very engaged on natural gas. As we've talked about, 2020 was going to be a year where there was potentially going to be some weakness in the gas market given where European storage sat. We think we've got through the vast majority of that weakness, and as we head into 2021, we still have a very constructive view on the commodity, looking for about $2.75 to $3. However, what I would say is as clients start to turn the page on 2022, the outlook is even looking more rosy in our view, and that's really being driven by two things. First and foremost, we really don't see a supply response next year coming from the gas basins, and with the associated growth effectively held at maintenance capital levels, that's going to keep supply in check. And secondly, as we head into 2021, we think we're going to be about 3 BCF a day, weather adjusted undersupplied. That's going to get us back to normalized inventories by October of next year. And we're setting up for a potentially 4 to 5 BCF a day undersupplied market in 2022. We're still working on the macro behind this, but essentially the punchline is we think there's a very good shot. We see $3.50 to potentially as high as $4 in 2022 before the back end of the curve gets to a point where producers hedge and we start to see that supply response. So from a gas standpoint, things are looking better and better as we've finally gotten through this weakness in 2020. And we're definitely starting to see a big uptick in gas equities. And from an exposure standpoint, generally speaking, long only and hedge fund accounts are wanting to kind of dig into a lot of the fundamentals.
Boy, at $4, there's some gas players that just make some insane amount of money. I'm thinking your forecast is catching some people's attention.
That's correct. Really, the forecast is for 2022. The back end of the curve, given the backwardation today, really isn't at a level where we think producers will hedge below 275 and headed towards 250, which is where the curve has been for some time. Generally, that's an area where you're not going to see a supply response and potentially see production and decline in some of these basins. As the front end of the curve for 2022 inflects higher, we think the back end of the curve will head towards kind of 275 or 3. Producers will hedge that price point and start some moderate growth, and that will balance the market. So this is more of a 2022 conversation. Yeah. The back end of the curve still looks really healthy.
Well, Matt, maybe you just give us the thumbs up, down, or sideways. Investors are seeing M&A activity. They're seeing, at least even if it's 2022, some potential for some better gas prices. Is the mood picking up out there? I'm leading the witness because we all love it when you say it is.
Sentiment's improving. I think it's just a duration question. We need to see the back end of the crude curve start to move a bit. And I think as that crude curve moves and the industry consolidates, there's going to be some real investment opportunity. We just have to get through the next few months and kind of work through the inventory levels on a global basis.
You've got the 12-month strip on natural gas a little above $3 an M, but a lot of the equities are dialing in much lower in their NAVs. So there is an arb to be had here, and that's part of the positive story.
So Michael's going to give us a view on what ifs about the future, presenting the 2020 energy outlook from BP. And so we thought it might be useful to have some charts on where we've been, what has actually already happened to help situate the conversation. So the first one we have here is the S&P GSCI Industrial Metals Excess Return Index. What we like about this is it incorporates investment returns from the term structure across a number of LME-based metals. You can see that the starting date is in the 1970s. We get to today in 2020, and obviously you see the normal troughs and peaks of commodity cycles. It's not so easy, though, to see the cyclical component within this time series. So here we strip it out for conversation. This is the short cycle or consumption cycle within that metals index. You'll see that it matches up with what you would expect it to match up against. In other words, various financial crises and commodity booms dating all the way back to the 1970s. Notice on the right-hand side of the chart that we're not at the trough for this consumption cycle. We're a little bit off that trough. Doesn't quite feel like it during COVID. If we had not had COVID, we certainly would have had a better tone to commodity markets in 2020. We can also pull out the investment or CapEx long cycle from the time series. And here you can see that, again, matches up pretty well with what your intuition would tell you, that you would see a sharp drop off in CapEx in recessions, such as the double dip recession in 80 to 82, 08, 09 in the Great Recession, and then that mid-cycle pause in 1995 to 96, which marked a transition into the late stages of that particular commodity cycle. Notice that today, from a metals perspective, we're still searching for that midpoint in the long cycle, the investment cycle, but it strongly implies that a lot of capital is going to be deployed in the next couple of years to finish out this cycle. Clearly, our conversation today is energy, so let's move away from metals. Here's the same family of indices, but now looking at WTI crude oil. The data goes back to 1986. And you can see if you looked only at the time series on the left, a value buyer might be very tempted to just jump in and say, let's get long crude. Now, I'm sure Michael's going to give us some cautions about why this time around a pause might be merited. But notice that cyclicality still exists in the oil market. And you can see here again, all the typical dates that one would expect: bull markets beginning in 1988, 1996, 2003, 2010, and the bear markets beginning in 92, 2000, 2008, and 2014. And of course, right now, we're somewhere in the middle from a consumption standpoint of the current cycle. On an investment standpoint, we can do the same thing we did before, and you can see that 2020 marks something that looks like a middle part of a cycle. It's not the worst it's going to be, it's not the best it's going to be, but certainly a transition concept is embedded here in crude. When we look at Brent and move away from the United States to a more international perspective, again, same story. On the left, the short cycle, the consumption cycle matches up with what an investor or a corporate might think of as the good days versus the bad days. Tougher to see, of course, is the longer investment cycle, the CapEx cycle. And here, 2019 is looking a lot like 2001. So we're in the early stages, just to be specific, of the next cycle. Now, as the chart shows, this can take a couple of years to form this bottom and head in the upward direction. And of course, it's an open debate on what portion of capital will go to oil versus gas versus solar, wind, and so on. And finally, here's the natural gas index, again, from a GSCI perspective. Notice on the left-hand side, from that particular investment strategy, a very long-run demolition of returns, but still the cyclicality becomes apparent, whether we look at the short cycle in consumption or the long cycle in CapEx. And so to finally make one last point, what's happening today is we've obviously had the COVID situation disrupting both the short cycle and the long cycle. And just updating our charts on central banks' balance sheets, since we went into the COVID period, we've seen an expansion at the four major central banks to the tune of trillions of dollars. In fact, looking back to September 2019, we're up $7.5 trillion for the total number across BOJ, ECB, Fed, and People's Bank of China. And you can see on the right-hand side just how enormous this provision of liquidity has been, even relative to the quantitative easing period that we saw back in 2013.
Great, Colin. I think we're all warmed up now, and we can get Michael in here. Michael, maybe just to kick off, if I know you've got some slides you're going to share, so I want to get to those, but would you mind talking a little bit about your group, the team, where they come from? I think everybody has such regard for the survey you guys have been doing for so long, but maybe don't know the full extent of the team or the history or things like that.
So just in terms of the makeup of our team, we all report to Spencer Dale, who's the group chief economist, who spent many years at the Bank of England. And we have people that are engineers, statistician, macroeconomists, sort of practitioners, people from all over the BP business that are part of the group economics team. So we're not all we're not all economists by training. And the major sort of output of our team historically up until about 10 years ago was just doing the statistical review and advising internal audiences when it was required. But it wasn't until about 10 years ago that we started doing the energy outlook. And so, I'll get to that in a second, but the statistical review this last year, we sort of had a soft release, which is unfortunate, but a natural reality of the sort of disruption that we were all living through, having to do what we do and still wanting to get the statistics out in a timely manner, but we weren't able to make a big sort of splash and conclusions around the statistical review like we had done before. Also, as we're all living through a pandemic, in 2020, how relevant is 2019? It's an open question. So we will likely come back to that next year and make a bigger deal, I think, about what 2020 actually showed in terms of the energy picture. And so also, as we were putting together the energy outlook, the coronavirus happened. And at the same time, BP got a new CEO and started rethinking strategy. And our energy outlook was pretty much already done at that point. We had finalized some of the draft, and we had main conclusions. We had our view of what the world would likely look like across all the scenarios that we had chosen, and we were a month away from hitting the go button. And for many reasons, both because of the reset at BP and because of wanting to take into account what happened because of COVID, we decided to hit the pause button. Originally, we were thinking, well, summer, and then finally we decided to make the release right around the release of the Capital Markets Day in early September. And I think it's never fun to do something all over again and go back and look at your assumptions, but I think every time you redo it, you get better. And so I think, the result is something that I think we're all proud of that we were able to do, and really we're one of the first, if not the first, long-term outlook to come out and try to say, look, here's our view of what we think COVID is going to have on the long-term energy system. So and I joined the group about a year and a half ago, and it's been an adventure ever since.
Great. I mean, that's a great intro, and also you guys are in such high demand. I got to say thank you for joining us. We've been really excited about this. Why don't we go ahead and let you jump into your intro, and then I know Colin's going to help all of us with some thoughts after you show us your slides.
But just to start off, there's always been interest in how we design the scenarios. And one thing that I would note here is just, when we think about where we're likely to end up in terms of the requirement to reduce carbon emissions, there's a very wide range that would be in line with Paris. And so what the chart on here shows is that this purple range is a very wide one, and that is where the rapid scenario lands, is somewhere in that purple range. It could land 5-10% higher or 5 to 10% lower and still be in line with Paris, and you could end up with a very different energy mix that would still be consistent with Paris. The other point to make here with this slide is that in order to get to a temperature rise that's no more than 1.5 degrees higher than pre-industrial times, you need to be in the blue range. And so that is an area that is just as wide. And then the final scenario is one which is similar to the evolving transition scenario that we've had in the past, and is one where you see similar policies and societal preferences as what we've seen in the past. So no real change. And I think the important point here to highlight is that climate change and carbon emissions are a stock, not a flow problem. And so we've been emitting emissions into the air for decades. We've been emitting carbon, and that will have an effect on the climate. And that has happened every single year since industrial times. And so the outlook going forward has to take into account what has happened in the past for decades and decades. And so getting onto that 1.5 degree path, or what some call a net zero pathway, where you're showing net zero emissions, is a high priority to deal with the fact that we've already built up this very large stock of emissions. So that's the first point that I would make. There are three key points and three characteristics that are the same in all of the scenarios that we highlighted. And it's the goal of doing this is not necessarily to say this is the scenario of highest probability, lowest probability, or in a rank, right? There's no probabilities assigned here. And as some of my colleagues would even say, they will all be wrong. And so in pursuit of that, in that spirit, what we're trying to do here is identify characteristics that are common across all of these scenarios, because we think that highlights the possibility or a probability of something that is more likely to occur than something else. And so what are the three main points? Number one, fossil fuels declines in all scenarios as a share of primary energy. Second point is that renewables as a share of primary energy increase. And third, electrification as a way of delivering that energy increases in all scenarios. And I would say, when we've done this chart for other regions, when we did it for China, we've done it for India, for the US, the way these lines all look pretty similar, and the direction is the same. There's some variation, but overall, this is the same across all major energy centers. The other point that I would make here is just the question of stranded assets and peak oil. And there's been a lot of media written and a lot of ink spilled on this question of peak oil demand. And the point I would make is that 2 of the 3 scenarios that we are sort of painting the picture around do show that we have peaked in terms of oil demand. But there is another scenario, the BAU scenario, which for some reason the label fell off here, shows that that peak has not yet been reached, and we will plateau through the 2030 timeframe and then decline from there. And in all of these scenarios, you see that there is a gap between what you would see from supply if you were not making incremental investments in new greenfields and what the demand profiles look like across all 3 scenarios. So that means that we're going to be investing in oil and we're going to be investing in gas for quite a long time to come. It's just a question of what type of oil, the location of that oil, and does that match up with the demand slate that we are going to see across all scenarios by the time we get to that 2040 to 2050 timeframe. And I would argue that today's slate is not necessarily best suited for what that slate of demand is going to look like in 2040 to 2050. It's going to be different. It's going to be petchem based. It's not going to be gasoline based if we see electrification take off in the way that we expect. And so the types of petroleum products that will need to be produced at that point in time will be different. The other point that I would make, and this is something that I worked on personally, is trying to assess the amount of investment that is needed in order to meet these demand profiles based on the 4 to 5% decline rate that you see from with a lack of investment in new greenfield assets. The point here is just to show that in those rapid decarbonization scenarios, you need to see just as much of a step change in terms of incremental investment as the step change required downward in oil and gas, but yet it's still a significant amount. The final point to just note in this chart is to show that the amount of CCUS that we're drawing on, the carbon capture, use, and storage investments that are required, even in those deep decarbonization scenarios, is very low. We're talking about 100 billion per year. And so this is viable technology. Some subsets of CCUS are viable. The U.S. has many great opportunities, and there's now tax incentives in place for this. But this is a really important component of the investment picture that I think needs to be paid attention to in the next couple of years.
Michael, it could just be a lot larger, that it's a relatively conservative assumption. Is that the point you're trying to make?
The point that I'm trying to make is that when you compare it to the amount of investment needed in wind and solar in the rapid or net zero scenario, here you're talking about 550 to 800 billion per year of investment in wind and solar, and you don't necessarily need to be spending those kinds of quantities to deliver on the CCUS required in order to meet the decarbonization scenario that we're talking about. That's what I'm trying to say. Okay. So, and I would say from where we are right now, right, the 2013 to 2018, there's not much investment at all in CCUS, and even in order to change that, it's not that much of a leap to see that kind of investment in something that is delivering real results for that decarbonization. Obviously, we need carbon prices, we need policy, we need lots of different things also to align, and more technology and more demonstration of this technology. But I think it's important to just note that as part of the investment picture. The other point that I would make, and this is a little bit, it goes along with the previous slide, but how do we get these numbers, right? So the numbers in terms of oil demand come from a very complex transportation model with a mode choice, vehicle choice, model that's been built up over the last 10 years. And the share of vehicle miles traveled or vehicle kilometers traveled is much higher rates of electrification in those deep decarbonization scenarios like rapid and net zero. But in the BAU scenario, by 2030, still the amount of electrification in the global fleet is not that high. You know, it's less than 10% in that BAU scenario. It gets up to 25 to 30% by 2050. And the reason I point this out is to mention that in that BAU scenario, as shown in this chart on the right, the bigger savings come from the fuel efficiency of the internal combustion engine. So the existing technologies that exist right now in terms of turbocharging, 48V, seeing some of what we see in developed markets getting used in emerging markets, truck hybridization and car hybridization, all of that is in this green component across these scenarios, and that's the biggest savings in terms of oil demand and carbon emissions in these scenarios. Now, of course, people will push back and they'll say, well, what about Africa? Or what about all of those people that are going to be buying cars in the next several years? And I would say, well, one, they may have to wait in terms of the effect of COVID, which we can get to in our discussion. And second, we're taking that into account. That's what these blue bars in the positive realm are taking into account. And so on a net basis, it's still a decline across these scenarios. And that's where this comes from. And it's the improvement in battery cost as well that drives this and drives that crossover in terms of the total cost of ownership for an electric vehicle versus an internal combustion engine. So in terms of what that means for the supply side, we can come back to this. I think the most important thing to remember in terms of how supply meets demand is what's OPEC's strategy in that environment. Is it going to be profit or revenue maximizing, or is it preserving market share? Is it going to take its cue from what non-OPEC does, from what non-OPEC supply does as a result of the prevailing price level? These are key uncertainties, and we've drawn pictures in these three scenarios that seem to make sense in terms of the ideal OPEC strategy. And what that means is that in a scenario where oil demand is falling by 2 million barrels a day per year in that rapid scenario from 2030 to 2040, we're likely going to see a much higher rate of supply and higher rates of supply growth from OPEC countries in that time frame. And as a result, it means that non-OPEC supply may lose out in that world. And so that's what this is showing, is the other non-OPEC supply in that rapid scenario is declining pretty steeply in that 2030 to 2050 time frame, and leading to the result that we have here. Tight oil, obviously something that a lot of your clients and a lot of you are spending time on. We don't think that that tight oil production has peaked. We think that there's a likely scenario, at least in the scenarios that we've put forward across all of them, that between now and 2030, that production in the basins that are producing mostly in the Permian have the ability to grow again, not at 2 million barrels a day per year as we've seen in the past, but it's something that can be gradual, 200,000 to 300,000 barrels a day on average, sort of in the low 200,000 barrel a day on average growth from the 2019 level. So that's there's more detail in the report on that. The final slide I wanted to show for those interested in what happens in the downstream is just to show the stark contrast between the BAU scenario and a rapid scenario that gets us along the pathway to a Paris or 2-degree scenario. In that scenario, refining throughput falls pretty steeply, going from about 72 to 73 million barrels a day down to about 35 million barrels a day. So upwards of 30 to 40 million barrels a day of a decline in refining throughput. And obviously those refiners that are advantaged, that are either in emerging markets or have access to global markets, are going to be more shielded from the impact of this refining rationalization in that scenario. But it is a very sharp and very large reversal in the need for refined products. And some of that is going to be some of that dynamic will obviously be helped by the fact that in that rapid scenario, we see increasingly you see the source of some of those hydrocarbons coming from non-combusted or from natural gas, and then bypassing the refining system, or from biofuels. And so that's the driver of that forecast in that scenario. So I will stop there. There's more, obviously much more 100-some page book with lots of different material on lots and lots of different things, but we can come back to any of those other questions in the discussion. So thanks.
Well, maybe just to get it going, Michael, that was a great kickoff. In your experience, when you talk about your work, what are the 1 or 2, 3 issues that people always want to talk about, zero in on? What do you find yourself talking about most of the time?
People always like to question the macro assumptions. They want to know and understand the GDP forecast, the population assumptions that we use, the way in which prices are used, which we're not going to talk about publicly. So I would say those are some of the things that people like to ask about. I think people are also like to try to understand how things have changed from last year to this year, and obviously a lot has changed. We're living through a global pandemic. We think that remote working is going to make an impact, and a lot of people ask about how we came up with those assumptions, and what's the future of business travel. And these are questions, I think, to be completely frank and honest with you, nobody has good answers to. We're not through this yet, and I think the survey data, just to briefly go on a tangent here, but when we go and try to assess this, we have to understand, well, what are the occupations that can have a remote working capability? Then to what extent are people willing to do that if they can do that? And then how much were they driving anyway, right? And so, you think about New York City, people may, like I used to, maybe take the New Jersey Transit in, so there's no offset there between I'm working from home or in the office, other than the fact that I may make an errand or two during the day. So, and I think to get to the point, survey data provides the basis for that question of, are you willing to work from home? And if you answered that survey data and 2 months into the pandemic and said, I'm willing to work from home X amount of days a week, and then you ask that same person, now that we're living 8, 9 months into the pandemic, are you willing to work from home that same amount of time? You might very well get different answers, right? And so a lot of this analysis, not only that we're doing, but the IEA is doing and OPEC is doing, we only know what we know at any given point in time. We have very little visibility, and I think that at the end of the day, when we have different facts, we got to change the story and change the view, right?
I was going to say they should have done the survey of the spouses and see how they felt about those people staying home.
Exactly. Tired of making lunch for myself.
That's right. Colin, why don't you jump in?
Yeah, so Michael, great presentation. Thanks for joining us today. Just a point of clarification on your first point. So obviously the carbon cycle is a flow on this stock versus flow concept. And so we, as humans, put carbon into the atmosphere and the oceans, and the plants take it out. So your point actually, though, is that there's a net stock in addition to the flow, so that there's a deposit that's not taken down. So you're not saying It's not a flow. You're saying that there's a residual in the
this,
flow.
Exactly. That the stock is the problem. It's that we have this stock that's built up.
Right. So
and so therefore going forward, if flow is the only way we can deal with net stock, there's a finite carbon budget, then we have to get that flow down, that annual flow down as quickly as possible. That's sort of what I'm trying to say.
That's why I think your fourth point is so interesting, right? Because there isn't a fixed carbon budget if there's direct air capture. So this all hinges crucially on your $100 billion not being $500 billion or whatever is the number that none of us know in order to have that reversal. How do you think about that tension? Like, what's your view on what might happen in next year's outlook or 2 years forward if that number suddenly is 300 billion, or carbon engineering surprises us and there's suddenly a different cost and it's the levelized cost we're all talking about? I think it'd be useful if you could tease that out a little bit.
Yeah, I mean, I think it's difficult because the IEA wrote a really great report called Energy Technology Perspectives. It came out back in the late summer, and it was the first report in maybe 3 years. And when I was at the IEA, I think there was only one report that came out in between that time, which was 2013, and they had one, and then the most recent one came out this past summer. And in it makes a really important point, which is that half of the technologies that we need in order to get from what the IEA calls their sustainable development scenario to a net zero scenario, half the technologies are still in demonstration or prototype phase. And I think that the report did a really great job, which we don't claim to be able to do within BP. We have technology teams working on this, but we didn't do a broad, listing of individual technologies. They did, and they made this conclusion to just highlight how much incremental, what are the nature of the technologies and how much can they deliver to get us onto that lower emissions pathway. And we're in the transport sector, we're talking about, full electrification of trucks in, CCUS, all different types of CCUS. I can't claim to talk all about, but those are the technologies that we need to see breakthroughs in. That's why we see these funds that are starting up and that are trying to get get those technologies more to not just in demonstration, but into a mature phase.
And just to make a point that you guys do in the outlook for the audience, in case they haven't read it,
sure.
This outlook is based off of existing or current technologies, and so it acknowledges there may be future technologies that none of us know about, but it isn't going to try to build in to the scenario, the magic dust that nobody knows about.
And I
think, just to illustrate that. Yeah,
and I think we discussed that a lot, and I think it's important to understand that we as a company, well, no, I shouldn't even say that, not we as a company, but we as a group within a company that are trying to put out an impartial outlook about what we think the future will look like. We don't want to be saying, well, we think direct air capture is going to be the magic bullet, or that natural climate solutions are going to be the magic bullet, and therefore no, oil demand, instead of going to 25 million barrels a day, can stay at 50 million barrels a day because we suddenly have these other magic bullets that give us a free pass, right? We're saying, and what we wanted to demonstrate is that there are ways to get to a low carbon pathway within the confines of the energy system. And yes, some of those technologies are not fully at scale, but we think that they can be. We think that battery cost curve can continue to decline. And that's something that we struggle with, and it's obviously part of what makes some of these forecasts, so variable.
Just the sheer growth of population around the planet is something that is always seems like it's a dominant factor in so many people's energy forecasts, whatever the conclusions they come to. How do you think about population growth, and just big picture effect on energy demand?
From a big picture perspective, I mean, we're using the UN population figures for this. It becomes significant towards the end of the forecasting period. And if we, for example, there's this Wittgenstein scenario where it acknowledges the fact that the global population is older and smaller. And so that's roughly 3.5% lower than the UN scenario that we use for this report. And we did some calculations with this. It's not a huge impact. It does lower global GDP growth by about 0.1 percentage points over the course of the outlook. So it's something that we dealt with, but it's not something that we've focused on in a big way in the report, at least this year. I think the other thing, or sorry, one thing just to add really quickly. I mean, if we are on a BAU scenario, or if we draw a line and say we're on a scenario like we published last year that might be more energy, you start to think about what catastrophic flooding and catastrophic effects of climate change might look like in 2050. We have no idea. That could have an effect on population just as much as it could have an effect on economic outcomes at that point in time. So just to stress, there's a lot of uncertainty with this. We're trying to be very clear with the assumptions that we've made. There's, pages upon pages in the annex to the report. And we firmly believe that being transparent allows us to get feedback on what we're transparent about, rather than just drawing a line and saying it's going to be X or Y. That's a fundamental rule of forecasting that I'm sure you all are aware of too.
Michael, you hit on one of the really important topics, which was COVID and kind of the temporal impacts around COVID, which we've obviously seen a significant drop off in demand, but what looks to be a fairly decent V-shaped recovery, although things may be moderating out here a little bit. I was curious, as you look at your forecasting and kind of look forward, can you speak to some of the structural impacts you potentially see and in the oil market where that may be having a bit more of a lasting effect than we may be thinking about at the moment?
The most lasting impact, I think, will be the effect on GDP growth. And when we've looked at the output, I think it's 2.5% by 2025 and 3.5% by 2050. So what that means from an income or purchasing power and productivity perspective, all of which are going to drive the macro side of things, it means, less global trade. It means, it can mean more protectionism, higher tariffs. We did some scenarios around a less globalization outcome where tariffs were increased by 50%, and then looked at what that would have an effect on in terms of economic growth. So in addition to that component, the behavioral impacts in terms of decline in business travel, a decline in tourism related travel. Sure, we did make adjustments and offset for aversion to public transit, again, in the medium term. But those fall away as we get into the 2024, 2025 timeframe. So remote working, by 2025, 2030 drives about a 1 to 1.3 million barrel a day decline in road fuel demand. And that is something that we've calculated at a country level based on literature and survey data that we tried to scrounge, as much as we could during the second quarter, and try to make some informed decisions around that. We didn't take into account urban flight. We didn't try to take into account, that variation in what you might have in a country like China versus a country in India, versus in India or Africa. We tried to make reasonable assumptions based on the survey data that we had. And obviously, as the teleworking capability increases, you're going to see a bigger impact. And the other thing that we struggled with here, which I think will be of interest, is to say, well, look, was this just a catalyst taking into account the emergence of these technological capabilities, we're now all being forced to use these technologies where we may have taken our time to actually use them before. It's this global experiment. It's just completely unprecedented. All we have to know is what are the Google, Apple mobility indicators telling us versus the real-time EIA, gasoline data. In same thing for Europe, same thing for China. All we know is that those seem to, in aggregate, be calibrating to a very permanent loss of jet fuel, 8 million barrels a day of demand, and very permanent loss, even in places where things are up and running again, in terms of people that are traveling, making that commuting trip. So we think that this is a permanent shock, and I think the real question is, was it inevitable anyway, at a certain point? And COVID just accelerated it.
One aspect of that kind of observation, though, is that it's not just about oil, gas, and coal. It's all energy. Mm-hmm. So the scenarios talk about a deceleration to 0.3% compound growth through 2050, and the rapid and net zero scenarios both make that assumption. Just with that in context, last year's number was 3.3 for global primal energy demand, and the CAGR for the past 30 years, according to the statistical review, is over 4%. Mm-hmm. So as you think about, okay, that's certainly one scenario, two scenarios, and you mentioned that you guys have run others. Do you envision that it will make sense at some point here the next year or two, if we got a rebound in economic activity, to start to build in scenarios that don't see that kind of deceleration? That's a 90% deceleration in a CAGR, which anybody who's run a forecast understands that is a big, big slowdown. It results in a pie that's only 10% bigger 30 years from now, with 2 billion more people and $100 trillion. Can you walk us through a little bit how you think, about, well, what if that number is really 1% in terms of the compound growth? It's still a deceleration, but now it's 3 times what these scenarios say.
Yeah, I would just say that, we expect that there will be other factors that will influence the use of energy on a per capita basis and a per unit of GDP. So that is accelerating already, and we've seen that in the last, I think the number that you're citing is something that is a far longer duration. But I think if you were to look, and I'd have to go back and check, but I think if you were to go back and look at efficiency gains over the last 5 years, the way in which you were producing 1 unit of output per person, especially in industrialized countries, is improving at a faster rate. So, I think it's a fair push. I don't know. I'd have to go back and look at, how that compares in the more near time frame. But I think at the end of the day, we see permanent scarring from COVID. And that is something that we think is going to have an effect, not just through 2025, but through the remainder of the outlook. And it's going to hit EM countries hardest because they won't have the fiscal maneuverability to get people back up to the levels that they were before. Even if the path itself is something that resembles what we had before, it's starting from a far, far lower level.
Well, maybe that's one way to answer. Instead of getting too focused on the numbers, maybe it'd be easier for the audience to follow if you describe the term societal behavior and preferences. What does that mean in terms of what people give up? Like, what is the rationing? Does it mean that they have to have ride sharing so you don't have a personal automobile in the year 2050? I mean, I'm not trying to lead the witness here, to use Maynard's term, but
no. I mean,
because the idea of 0.3 is ethereal to a lot of people. When you guys write that into the
Michael, Colin is very worried about what you're going to ask him to his new lifestyle, I think, is the question.
No, I mean, it's there are several things, right? First, in a net zero scenario. So I think just for people's context, what we're talking about here is that in order to get to a rapid scenario, we start now, right? That starting now, there's efficiency gains, there's levers, there's electrification, there's buildings efficiency, and there's all the different things that we lay out in the outlook that start us on that rapid path. Technology and policy working in lockstep with one another to get onto that path. And we highlight an alternative pathway, which is that we mosey on down the path of BAU for the next 10 years, and then all of a sudden wake up and decide, well, we really need to get back onto rapid. Well, we can expend all those efficiency levers and all of those technology levers that we want from 2030 onwards to 2050, and we still won't get to rapid. And so the point of delayed and disorderly is that in order to get to rapid as quickly as possible, then you need to see rationing. And so what does that look like? It's, we all have to, Amazon makes one delivery in your neighborhood during that week, and you all walk out and go and get it. Or you take one airline trip a year to visit your parents instead of 3, and instead you just don't go on that vacation. And these are really, the point is that these are really uncomfortable things. Nobody wants to have to say that the only way to get back onto that pathway is to reduce consumption. But that's the point, is that if nobody wants that, right, then getting onto rapid right now is the least costly and least disruptive way to get into that low carbon pathway. And the same theme works for a company, right? It's why why our chairman a year and a half ago wrote the editorial that he did in the Financial Times to say, look, we don't want business as usual. We want to be on that rapid pathway. And we think that transitioning to that now, it will be less costly to us and provide more value, over the course of time than if we delay, right? And so that is coming through here, and we've been able to show that. There's a whole section, 3 or 4 very, very nice charts in the report that show nobody wants that rationing, but it's certainly going to cost us a lot to have to do that.
Oh, for sure. I mean, it's like 50% of global demand in 2050 and 25% for 30 years. It's more than one trip to grandma. You will not be on an airplane for a long time.
Yeah.
I have a question though on that. That's a demand side solution. One thing we talk a lot on this show, particularly because we, like you used to do at Barclays, and even internally, spend a lot of time with gas producers. And there's this risk that nuclear comes in with its zero emissions. And contrary to public perception, its excellent safety record. And the supply side solution is you go to 100% electrification and 100% nukes, just to make an argument. How do you think about nuclear coming in, and that as we're all in the fixed mind, afraid, let's go through demand and solve the equations, that the nuclear people come in and say, thanks for your lunch, I'm taking it all. And you get a supply side solution, and demand is able to scream higher because we have an absolutely cheap, reliable, abundant source of energy.
Right. So I think that, we lean on nuclear to various extents depending on the geography. I think that nuclear will have several challenges that it will face. Number one, needing to see capital costs come down. I think the second probably relates to good execution in terms of construction, which has not been great over the last couple of years. We all know the issues related to siting and the Yucca Mountain fiasco in the US and trying to deal with the waste problem. Now, can those issues be solved? Absolutely. I went to my first nuclear power plant when I was a young, second, third year analyst at EIA, and to the North Anna plant, and I think Dominion owns that plant, and so they showed us and wowed us with all the different safety things and pristine facilities and everything, and I was floored. It was amazing to see, and I said, look, why don't we see bigger pickup? And the guy, the nuclear engineer, site manager of the project, said one word: politics. Right. So I think there's a lot of different challenges. We got water for cooling in a world where we have rising sea levels or drought. That's going to be an issue as well. I think there's a lot of really interesting stuff and work that's being done at MIT. And so, all of that stuff is going to be really important, but we don't lean on it very much in this outlook.
Well, Michael, we're kind of getting to the top of the hour. You can tell we could just be going on and on. All we need is some bourbon and cokes, and we could really go for a while.
Sign me up.
That's COVID talking. Maybe as we wrap up, one thing we were doing last week, it was fun. We were talking with the team about just the logistics of the minerals and the metals and everything that has to happen in terms of mining and production for wind and solar and batteries and renewables. And it was sort of a daunting task. Lots of money, lots of activity. And you kind of stared at that and said, wow, that looks logistically so hard. It doesn't look, it looks like it's going to add some CO2. And it just kind of made you scratch your head. I know you've looked at that chain. I was just curious, since we just did it last week, what do you think about that process?
So I think, there's a lot of concern right now over whether the lack of investment, for example, in copper could be a bottleneck for battery electric vehicles. And we are of the view that, at least the current chemistry, the current lithium ion family of batteries is going to continue to dominate the mobility applications, at least for the next 10 to 15 years. And those batteries are going to have a higher and higher share of nickel content over the sort of medium term, and higher energy density and lower cost. So this concern about the concentration of cobalt in some of these at-risk countries, I think will dissipate as the chemistries evolve. And cobalt is being, rapidly engineered out of these batteries. And so it's not clear when they'll remove it completely. But I think, the other thing is, and I think a lot of people are more concerned about the sort of cradle to grave element in terms of emissions.
Yeah.
For battery cycle versus an internal combustion engine. And it is true in certain geographies where, you're driving a BEV is not necessarily better in terms of emissions at that moment in time than filling it with gasoline. But most studies, I would say the vast majority of reputable studies, including from the IEA, including from think tanks that have looked at this stuff, they all indicate that still a BEV that is driven for more than 6-7 years, they all will start off with a deficit of something like 6, or it's going to take, in terms of making the emissions equal from a cradle to grave perspective, it's going to take something like 5 or 6 years to get to that point. But once they're beyond that point, they start to exceed the emission savings of the equivalent ICE vehicle. If that helps.
Well, I hate to wrap it up. I've got to do a big thank you to you and the BP team, and to you guys for all your work. All of these things are, as you said, they're incredibly difficult to stare out into the future. And every time someone as talented as your group tries it, we all get a little better, a little smarter, think about issues better. So you are to be commended on all this, and we can't thank you enough for joining. I also, as we wrap up, I want to thank David Ferris at the Rani Irani Center again. It's great to be here. I think it's all about innovation going forward, and that's what they're doing here. So thanks to all of you. Stay safe. Thanks, team.